so many instances, entities will sought for finance or borrowings of funds in financing their construction or purchasing of a particular asset, because it's not always the case. They can finance those assets from the equity capital of the entity or the equity source of the equity, and therefore they have to sort for the debt capital. And when we look at IAS 16, where you want to look at the initial measurement, we said that it should be measured at cost. That is, property, plant, and equipment should be initially measured at cost. And if it's supposed to be measured at cost, and then the entity take a loan or go for borrowings of funds to finance the construction or acquisition of that asset, then there is a cost that the entity is going to pay on that debt. And that cost must be captured as part of the cost of the asset. So basically, in international accounting standard, they refer to it as borrowing cost. So today, that is what we are going to look at, and it has its accounting treatment prescribed in the International Accounting Standard 23, that is IAS 23, borrowing costs. So when the entities go for that loan or borrow that fund, the cost on the fund is the interest they are going to pay. Is that okay? So for instance, if an entity is going for a loan of $10,000 at an interest rate of 6%, they are going to use this loan for the acquisition or construction of an asset. Then the cost on the loan, we are saying that is going to be the 6% on the amount they are paying. So in this case, let's assume the 6% on this is going to give us something 600. If that's the case, then the cost on the borrowing is this 600. And according to IAS 23, this cost on the borrowing must be captured as part of the cost of the asset. So basically, that is the idea of IAS 23, borrowing costs. The main objective of the standard is to prescribe the accounting treatment for borrowing cost. So borrowing cost, what then is borrowing cost? When we talk about borrowing cost, we are saying that it's basically the interest or any other cost that an entity incurs in connection with what? Borrowings of funds. So any interest or other cost an entity will incur in connection with borrowing of funds is referred to as borrowing cost. So when should an entity recognize borrowing cost in the books of an entity or in the financial statement of an entity? We are saying that an entity should recognize borrowing costs in the books of the entity or in the financial statement of the entity when the borrowing cost is directly related to the purchasing, to the construction or production of a qualifying asset. Anytime the borrowing cost is related to these activities, then the borrowing cost must be capitalized in the books of the entity. So we are saying that if it is related to the construction, acquisition of what? Qualifying asset. Sometimes that the entity will not go outsource their purchasing of an asset to an asset that they build it themselves, like mostly the manufacturing firms. Or sometimes they will go and buy it from outside. That's why the word is acquisition or construction of a qualifying asset. Now, I've used the word earlier on, which is capitalizing. Anytime you are capturing, you are adding a borrowing cost. The process of you adding a borrowing cost to the cost of an asset is the process. That process is what we call capitalization or capitalizing. So here we have seen another new word, which is qualifying assets. Qualifying assets are assets that necessarily takes substantial period of time to get ready for its intended use. that is qualifying asset. Any asset that would necessarily take a longer period of time to get ready for its intended use or for sale, then we classify it as what? A qualifying asset. A typical example would be property, plant, and equipment. We can have made-to-order inventories. Made-to-order inventories, or inventories that will take long or have series of production process before it will be ready or be brought into its finished goods. Those inventories also fall under qualifying assets. We can talk about intangible assets. Intangible assets. We can also talk about investment properties. Investment properties. All these fall under a qualifying asset. So basically, we say that an entity must recognize a borrowing cost if that borrowing cost is directly related to what? To the production, construction, acquisition of whatever qualifying assets. Now we want to look at the presentation and measurement of borrowing cost. Now borrowing cost comes in two methods, or the standard prescribed two methods of capitalizing borrowing cost, and under each method and what you are required or you are supposed to do. Okay, so we'll take it one by one. So we have, when we take specific loan, that's the one, and the second one is when we are looking at a general pool of loans or general loans. So here we have two methods and how you should account for borrowing cost under each of the methods. Remember that borrowing cost, the idea is basically capturing the cost on your borrowings, like established earlier on, as part of the cost of what? Of an asset. So for instance, if we are constructing an asset which is costing us $1,000, and then the borrowing cost, we borrowed a fund of $500, and then the interest was 10%, then the cost on this is going to be the 10% multiplied by this, which is going to give us 50. And we have to add it to this because this is our cost, because it's supposed to be captured, and it's going to give us $1,050. What I have just done here is an idea of a loan taken specifically for a particular project or for a particular asset. So, like I said, we have two types. We have the one taking specific loan and then the general pool of loans. So let's take the specific loans first before we come to this one. With the specific loan, like I've established with these examples, the loan is taken specifically for the construction or acquisition of that asset. So here we have taken $500 at a 10% interest, specifically for the construction or acquisition of an asset which is costing us what? $1,000. So the 1,000 here is the cost of the asset. Please note the critical things over here. With a specific loan, the interest is calculated on the fund borrowed, on the amount borrowed, not on the cost. So with a specific loan, the interest is calculated on the amount borrowed, not on the cost of the asset. Always remember that. But you are supposed to take into consideration the duration that the construction will take. And then we are supposed to also take into consideration investment income. Now I'm explaining these two things I have just listed. Sometimes the construction will not last for 12 months or 1 year. It will last for just, let's say, 8 months. 8 months. If that's the case, then your borrowing cost here is not going to be 50 because it's going to be the 50 multiplied by 8 over 12. How am I doing this? Is because the construction of the asset or the acquisition of the asset didn't last for the full 12 months. If that's the case, then whenever you are capturing or capitalizing borrowing costs on a fund, then you are supposed to take the duration the asset will take into consideration. So that is it for the period of construction. The second key item I also mentioned was that there are sometimes you will take the fund, but you will not start construction on the day that you take the fund. If that's the case, then you are supposed to what? If that's the case, probably entities will invest the fund into an investment portfolio, and they probably earned somewhat investment income. If that's the case, let's assume that there is an investment income of $10 over here. Then whatever you have calculated as your borrowing cost, you must take your investment income from it. So assuming here we are getting something like 45 as our borrowing cost, we have to deduct this 10 to get 35 as borrowing cost. This is the final figure we would have added to the cost of the asset, or we would have capitalized as borrowing cost. So please take note. Here again with the investment income, there are some times that the investment will not last for 12 months. It will last for 6 months, 3 months, 2 months. Then you are supposed to also take that into consideration when you are calculating for the investment income. So all that I've said so far, let's use this example to augment our understanding. So here we are saying that let's assume the cost of an asset is $5,000, and we take a loan of $10,000 for the let's make it $1,000 for the construction of this. The construction period will take us 9 months. 9 months. We didn't, when we take the loan, we didn't started using it on just the same day. We invested part of it. We invested 200 in a portfolio that pays us 5%. This one is carrying 10% interest rate in a portfolio that pays. So this is an investment over here in a portfolio that pays for 6 months. 6 months. So calculate the borrowing cost on this particular asset. In this case, the borrowing cost to be capitalized here is going to be the interest on the loan. So here is going to be the interest on the loan, which is going to be multiplied by 10. Is going to give us our interest of 100. Now, this is not your borrowing cost, because in this case, there is an issue of investment income over here. So you first have to determine the investment income before you even come and determine this one. So first, let's determine our investment income. So in this case, it's going to be the 200 multiplied by our 5 multiplied by 6 over 12. So 5 on this is going to give us $10. So half of this is going to give us our investment income of what? Of $5. So in this case, our borrowing cost is going to be the interest on this, which is 1,000 times 10%. Please, is taking 9 months. This month might be multiplied by 9 over 12, or whatever we get here divided by less by 5 will give us our borrowing cost to be capitalized. Please, you see, with a specific loan, the interest was not charged on the cost of the asset. It was charged on the fund borrowed. And then we've also taken the month into consideration. So that is it when it comes to taking specific loan for construction or acquisition of a qualifying asset. Having established our understanding with the specific loan, now we want to look at the idea behind a general pool of loans. So here we are looking at the second method, general pool of loans. With this one, let's assume that I'm using an example to establish our understanding. So let's assume that the cost of the asset is $10,000, but we didn't finance the construction of the asset with just one loan. We had series or several loans that we use for the construction of that asset. So let's assume that we used a loan which was $5,000 with an interest of 10%. We use another one which was $10,000 with an interest of 5%. We use another one which was probably maybe $1,000, which carried an interest of the same 5%. So here we are financing the acquisition or construction of this asset from this pool of loans. Then the standards prescribe that the borrowing cost to be capitalized must be a rate which must be determined, and that rate that we will determine must be calculated on the cost of the asset. So you can see the contrary things over here. When it comes to general pool of loans, the interest is not charged on the loans, but the interest is charged on the cost of the assets. So here, which rate do we determine? The standard prescribes that we are supposed to determine what we call capitalization rate using weighted average cost. Using weighted average cost. So anytime the loan or the question is about general pool of loans, you first have to determine your capitalization rate. And then capitalization rate you have determined must be calculated on the cost of the asset. Please not on the loans taken. So in this case, it's going to be the 5,000 here. We are determining, how do you determine your capitalization rate? Is the summation of the interest divided by the total loans taken multiplied by 100. So in this case, we have 5,000 multiplied by 10% plus 10,000 multiplied by 5% plus 1,000 multiplied by 5%, all divided by the loans. So we have taken $16,000 loan. So the interest on this one is going to give us 500 plus this is going to give us 50. This is going to give us 5 for that matter, divided by 16,000, all multiplied by 100. So you are supposed to multiply by 100. So let's assume you do this correctly and we are getting 9%. Our capitalization rate is 9%. We are assuming that after doing this, you get 9%. Then what will be your borrowing cost? Your borrowing cost in this case, therefore, your borrowing cost in this case is going to be 9%, which is the capitalization rate you have determined, multiplied by your 10,000, which is the cost of the asset. And this will give you your borrowing cost and the general pool of loans. Again, if there is any investment income under this one too, you will probably have to less the investment income before you arrive at your final borrowing cost. So anytime a borrowing cost does not relate to a particular period, let's say this probably takes us 9 months to construct, then the 3 months which is not relating to the borrowing cost will have to be spent in the P&L account as well as an interest expense. So sometimes it can ask you to determine the borrowing cost and determine the interest expense. Any borrowing cost that is not related to the construction, to the acquisition, or to the production of a qualifying asset, that interest is captured as interest expense and is taken straight away to the P&L account. Now let's look at some few critical things under borrowing cost. All right, so let's assume that we've taken this loan for the construction of an asset which cost 10,000, and it lasted for 9 months. And then with these loans, we were told that the first one, the 5,000, which is carrying an interest percent of 5%, is a specific loan. It's a specific loan. So this is a specific loan. So what happens? And these specific loans was also taken for the construction of the asset. And this one was also taken for the construction. These are the two general pool of loans was also taken for the construction of the asset. And then let's say there was part of the general pool of loans, which was $5,000, was invested in an investment portfolio that pays 6% interest for 6 months. So the question is, let's take the question critically. We have these loans. This one is specifically taken for the construction of the assets. This one are general pool of loans, $10,000 with 5%. This one, and the construction of the asset will take 9 months. We have part of this one, the general pool of loans invested in an investment portfolio, which will take, which is having 6%, and we have investing it for 6 months. The question is, what then is your borrowing cost? Anytime there's a specific loan taken and there's a general pool of loans all in the same question, and the specific loan is taken for the construction or acquisition of your asset, then please, before you can charge your capitalization rate on the cost of the asset, you have to less your specific loan from the cost of the asset. This is the idea. You are constructing something which is 10,000, 10,000 and you've taken a loan specifically for it, probably you would have paid that amount. So the cost left would have been the net of that amount. So I'm constructing something which is 10,000 and I've taken a loan of 5,000 for it. Then I'll pay for it. So the what is left is what is to be 5,000. That will be the cost that will be financed from the general pool of what of loans. So anytime you have specific loans and the general pool of loans in the same question, please remember that you have to less your specific loan from the cost of the asset before you charge your capitalization rate on the remaining. So in this question, let's look at how we are going to go about it from the beginning to the end. All right, so in this case, let's first determine our investment income. So we want to determine our investment income. Investment income. In this case, it was 5,000. It was taken to the investment, multiplied by our 6%. It was there for just 6 months, so multiply by 6 by 12. So let's quickly do this. So 5,000 multiplied by 0.06 multiplied by 0.2, and it's going to give us $150. So our investment income is 150. Please remember that this one was invested from the general pool of loans. So let's look at our borrowing cost from specific loan. So borrowing cost from specific loan. The S means specific. So in this case, it's going to be, remember that with the specific loan, we charge the interest on the loan taken. So it's going to be the 5,000 multiplied by 10%, multiplied by the duration the construction will take, which is 9 months. So the 9 divided by what? By 12. So in this case, our borrowing cost from the specific loan is going to be the 5,000 multiplied by 0.1 multiplied by 9 divided by 12. And this is going to give it $375. Then let's look at our borrowing cost from the general pool of loans or pool of loans. Is that okay? First, we have to determine our capitalization rate before we can come and determine this one. So let's determine our capitalization rate over here. So we have our capitalization rate determined over here. The interest on this plus divided by the total loan taken multiplied by 100 gives us our capitalization rate, and we charge it on the cost of the asset. So in this case, it's going to be the 10,000 multiplied by 5% plus the 1,000 multiplied by 5%, all divided by here it will be 11,000. Don't forget to multiply all by 100 because we want it in a percentage form. So 5% on this is going to give us 500 plus the 5% on 1,000 is going to give us 50, all divided by 11,000 times 100%. So this is going to be 550. So we have 550 divided by 11,000 times 100, and this is going to give us 5%. It's also going to give us 5%. So this is a coincidence when we are having it to be 5%. It's not always the case that you get it to be like that. It's because of the workings. So now our borrowing cost is going to be, borrowing cost from our general pool of loans is going to be the cost of the asset. We will less our specific loans, whatever is left before you are going to charge this capitalization rate on it. So if you less your specific loan from the cost, you are going to get 5,000. So here our borrowing cost from the general pool of loan is going to be the cost, which is the 5,000. I hope you remember why we are getting this 5,000 is because of the specific loan. You are supposed to first less it from the cost before you charge the capitalization rate on the remaining cost. So this is multiplied by 5%. Please don't forget it's taking us 9 months to construct the asset. So here to multiply it by 9, and don't forget that part of this was invested. The general pool of loans was invested for a duration for a period. Okay, so then they had this investment income there. So we are supposed to less the 150 from it to get our borrowing cost from the general pool of loans. So therefore, what it means is that our 5,000, which is this one, multiplied by 0.05, this is which is going to be multiplied by 9 over 12, multiplied by 9 over 12, and you get 175 187.50 less by 150. So the loan from the general pool of loans is going to be, so the borrowing cost from the general pool of loans is going to be 37.5. So therefore, our borrowing cost to be capitalized on this particular asset is going to be this plus the borrowing cost from the specific loan, which is 375. So this is going to give us 412.5. So a dollar of 412.50. So this gives us the total borrowing cost to be capitalized on the construction of an asset, which is going to cost us 10,000. Remember that any other expenses, any other interest which is not capitalized here is going to be your interest expense in this case, in case you are asked to find. And remember that if they ask you what is the cost of the asset, then here after getting your borrowing cost, we are supposed to add it to the cost over here, which is the 10,000, to get the cost of the asset. So depending on what is asked in the question and what you are supposed to do. So please, this is basically to establish our understanding. Another technical thing under borrowing cost too is sometimes you have the expenditure on the assets done in a bit within the year. If that happens, how are you going to determine your borrowing cost? Assuming that they made a payment in 31st January, let's say they made a payment of 1,000. This is the cost of the asset or the expenditure on the asset. And then he again said that 31st March, they made a payment of 5,000, 31st March maybe, and then on 30th September in the same year they made another payment of 500. And then this is financed from a general pool of loans. If it were to be a specific loan, remember that you would have charged your interest on the loan you've taken, not on the cost of the asset. But with the one from the general pool of loans, we charge our capitalization rate on the cost. So if this is the case, then please take the years into consideration. So now we are paying in what? In January. So January will not be part, it will be from February to December. So here, if you are charging your capitalization rate, you have to multiply by 11 by 12. If you come here, since you are paying on 31st March, that is March, February, January is not part. So here you are supposed to charge the same capitalization rate, but it will be 9 over 12. 9 because from April to December will give us 9. If you come here, the same thing, you charge your capitalization rate and look at the number of periods left. So it will be October, November, December, which is going to be 3 over 12. So the summation of all this one gives you your borrowing cost. So these are instances where the borrowing cost, it will be paid, the expenditure on the asset will be paid in different periods. So you are supposed to take the periods into consideration. But let's look at the other issues pertaining to borrowing cost. The next one is, when should we start capitalization of borrowing costs on an asset? When should we start? The first one is that the standard prescribes 3 criteria, and of which all must be present, or 3 conditions, all must be present before we can start capitalizing our borrowing cost. 3 must be present. And the first one is that the expenditure on the asset must be incurred, or expenditure on the asset being incurred. That is the first one. Expenditure on the asset being incurred, expenditure on the asset being incurred. Second one is that the borrowing cost is being incurred, and the third one is that activities that are necessary to prepare the asset for its intended use or for sale are being carried out or are being incurred. So when all these 3 things are present, that is when we say that we are supposed to capitalize borrowing costs. First, when the expenditure is being incurred, when the borrowing cost is being incurred, and activities like maybe going for consultation, site preparations, anything that is directly related to the asset, those activities, if they are being incurred, then we say that you should start capitalizing borrowing costs. Please, until all these conditions are present, one cannot capitalize or cannot start capitalization of borrowing costs. So assuming that the expenditure was incurred in 31st of January, we went for the activity started somewhere 1st December in the previous year, and then the borrowing cost, we went for it on 31st of March in this year. So this is, let's say, 2011, this is also 2011, and this is 2010. When should we start capitalizing borrowing costs? It is the day that all these activities are being incurred, and it is on this date that all the activities are being incurred. So mostly it's 31st March 2011. Mostly the latest date is mostly the answer, but you have to take a critical look at that. Then when should we stop? Now we know when to start. When should we stop? When we should stop is when the asset is ready for its intended use or for sale. When the asset is completed, is ready for its intended use, then we should stop what? Capitalizing borrowing cost. Then another word has to come in, which is what? When should we suspend borrowing cost or suspend borrowing cost? What do we mean by suspending of borrowing cost? There are some times during the period that you are producing, the general development will be interrupted. The general activities on the asset will be interrupted. For instance, you are constructing an asset and due to lack of material, you were not able to produce from June to July. So in this period, maybe you are constructing from January to December. But within this 2 period, because of lack of material, because of shortages of labor, you were not able to work from June to July. And within these 2 periods, we are saying that you have to suspend your capitalization. In this case, if you want to calculate your borrowing cost, is going to be 12, is going to be 10 over 12, because these 2 months might be taken out as a month of suspension. Please remember, when I was using the example, I said lack of material or shortages of labor. That means that anytime it is the nature of the asset, maybe the asset must be left for some time before they continue the production. If that is the case, that is not suspension. And even if the activities are interrupted by natural disaster, like a flood, like a fire, which is earthquake or anything which is natural, that period you must not suspend your borrowing cost. It is only when it is by internal means of suspension, lack of material, or lack of labor, or any internal means for which you didn't produce or didn't construct in that period, then you are not supposed to capitalize your borrowing cost. You are supposed to expend or suspend borrowing cost. Remember that some asset like building will be left for some time before you can continue after maybe a particular level. If that's the case, please, you continue to capitalize borrowing cost. Sometimes the key word is substantial. If you see the word substantial period, then it means that one is very important, that they leave the asset for some time. So still you capitalize borrowing cost. So the next thing is disclosure of borrowing cost, disclosure requirements. That is, disclose the important things, whether the asset was financed from specific pool of loans, whether the asset was financed from the general pool of loans, how many months or how many years did the construction of the asset takes, how was the expenditure done, and any important thing, the interest that were not capitalized, when was the fund ready, which entity do we get the fund from, the financial institutions. All those things are disclosure requirements or information that you can disclose to the note of the financial statement. So that is it for borrowing cost. We are in the next video, or there will be a video where we will solve a full question on the standard. Thank you.